Hello, and welcome to March's 3 Slides in 3 Minutes. About 20% of the world's oil supply normally flows through a narrow waterway called the Strait of Hormuz. It's located between Iran and the Arabian Peninsula. Following the coordinated US and Israeli attack on Iran, shipping traffic through the strait has nearly stopped, creating the largest energy supply disruption in recorded history. While markets have stayed relatively calm so far, that calm is borrowed time. The longer the chokehold lasts, the worse it gets, and the math is straightforward. A 3 week disruption drags global GDP down by about 0.3% and pushes prices up by roughly 0.5%. Stretch that out to 30 days, and you're looking at a 0.5% hit to global growth and nearly 1% added to inflation. At 60 days, it's a 9/10 GDP headwind, almost a percent, and a 1.5% price spike. If flows stay depressed long enough for markets to start pricing in a prolonged disruption, oil prices could exceed their 2008 all time highs. This isn't a theoretical risk, it's a math problem with a ticking clock. So far, global markets have treated this conflict primarily as an inflation shock. Interest rates have moved higher, energy prices have surged, and there have been clear winners and losers based on which countries import versus export energy. But here's what markets haven't fully priced in: the growth side. Equities, copper, the Australian dollar, and other cyclical assets have held up surprisingly well, which only makes sense if you believe the war will be short lived. The downward sloping oil futures curve reflects that same bet. If the confidence turns out to be wrong and energy prices stay elevated, those resilient assets face real pressure. The growth downside becomes the next shoe to drop. Unlike the 2001 2002 pandemic shock, the current disruption is mostly confined to energy, which limits the risk of a broad second round inflation effects. But a sustained energy price spike still slows economies, squeezes consumers, and erodes corporate earnings. Markets are halfway through this pricing event. The other half could be rougher. Before the Iran conflict, the Federal Reserve was expected to deliver two final quarter point rate cuts in June and December, bringing the federal funds rate down to 3 by 3.25%. That June cut is now off the table. Higher energy prices have pushed the inflation forecast up enough that cutting in June would be premature. The revised expectation is September for the first cut, followed by December. Same destination, slower path. That said, the labor market is the wild card. The February jobs report was soft, and if employment weakens faster than expected, the Feds could move earlier despite the inflation noise. The key insight: the Fed cares more about jobs than oil prices. If the labor market cracks, they'll cut even with elevated energy costs because they know oil driven inflation is temporary, but job losses compound. So the question isn't whether the Fed will cut, it's whether the economy forces their hand sooner than September. Thank you for watching. And if you have any questions, please reach out.